Let me tell you the moment when retirement becomes real. It's not when you stop working. It's not when you turn 65. It's the first month when you need to pay your bills and you have no paycheck coming in. That's when you realize everything has changed. For your entire working life, money flows in. You get paid every 2 weeks or every month. You budget around that paycheck. You know exactly when the money arrives and how much it will be. Then you retire. And suddenly, there's no paycheck. The money has to come from somewhere else, from your savings, from your investments, from Social Security, if you're lucky. This transition terrifies most people, and it should, because if you get it wrong, you run out of money. You become a burden on your children. You have to go back to work in your 70s or 80s. You spend your final years in poverty and stress. I've seen this happen to people who saved diligently their entire lives but didn't understand how to generate income from their savings. They made critical mistakes in the retirement income phase and paid dearly for it. Today, I'm going to make sure that doesn't happen to you. I'm going to share the 3 income investments I would buy if I were retiring in 2026 and needed to live off my portfolio. Not growth investments, not speculative plays, income investments. Investments that send you checks every month or every quarter so you can pay your bills without selling assets at bad prices. These 3 investments are not exciting. They're not going to make you rich quick, but they will provide reliable, growing income that will last for the rest of your life and beyond. Before I reveal the 3 investments, let me explain what I'm looking for. Because the criteria for income investments in retirement are completely different from the criteria for accumulation investments when you're young. And first, I want reliability. The income must be predictable. I need to know that the check will arrive every quarter. I can't afford surprises or suspensions or cuts. My bills don't stop during bear markets or recessions, so my income can't either. Second, I want growth. This is what most retirees miss. They think income investments are about maximizing current yield, get the highest possible payment today. But that's wrong. Inflation will destroy you if your income doesn't grow. If you retire at 65 and live to 95, that's 30 years of inflation. Even at just 3% annual inflation, prices will more than double over that period. If your income doesn't grow, your purchasing power gets cut in half. You go from comfortable to struggling without your spending changing at all. So I need income that increases every year. Third, I want safety of principal. I can't afford to lose 30 or 40% of my capital in a market crash. When you're accumulating wealth, you can recover from losses. You have time. You keep adding money. A market crash is just a temporary setback. But in retirement, you're withdrawing money. A market crash combined with withdrawals creates a death spiral. You're selling assets at depressed prices to fund living expenses. Your portfolio shrinks dramatically. It never recovers. This is called sequence of returns risk, and it destroys retirement plans. So I need investments that won't collapse in value during market crashes. Fourth, I want tax efficiency. In retirement, you're likely in a lower tax bracket than during your working years, but you still pay taxes. And every dollar you pay in taxes is a dollar you can't spend on living expenses. So I want investments that generate income taxed at favorable rates, qualified dividends, long-term capital gains, tax-exempt municipal bonds, not ordinary income taxed, at the highest rates. Fifth, I want liquidity. I need to be able to access my money if emergencies arise. Medical expenses, helping family members, unexpected costs. If my investments are locked up in illiquid assets that take months to sell, I'm in trouble. Sixth, I want simplicity. I don't want to spend my retirement managing complex investments. I don't want to watch the markets every day. I don't want to make constant decisions. I want to set up the portfolio once, maybe rebalance annually, and otherwise forget about it. Those are my 6 criteria. Reliability, growth, safety of principal, tax efficiency, liquidity, and simplicity. Only 3 investments meet all 6 criteria well enough for me to trust them with retirement income. Let me tell you about the first one.
The first income investment I would buy for retirement is the Vanguard Dividend Appreciation ETF. The ticker is VIG. This fund invests in companies that have increased their dividends for at least 10 consecutive years.
These are high-quality businesses with proven track records of dividend growth. Let me explain why this is perfect for retirement income. VIG currently holds about 300 stocks. These include companies like Microsoft, Apple, Johnson & Johnson, Procter & Gamble, Visa, Home Depot, and many others. All of them have long histories of increasing dividends every year. The current dividend yield is about 1.8%. That might not sound impressive. If you invest $100,000, you get $1,800 in annual income, only $150 per month. But here's what people miss. That dividend grows every year. The companies in VIG increase their dividends at about 8 to 10% annually on average. So next year, your $1,800 becomes about $2,000. The year after, about $2,200. By year 10, you're receiving about $4,000 annually from that same $100,000 investment. Your yield on your original cost has grown from 1.8% to 4%, and it keeps growing. By year 20, you're receiving about $8,000 annually, 8% yield on your original investment. This is the power of dividend growth that retirees completely miss when they chase high-yield investments. They buy something yielding 6% today that doesn't grow. 20 years later, they're still getting 6%, while inflation has eroded their purchasing power by 60%. Meanwhile, the dividend growth investor started at 1.8% but is now getting 8%, and that income keeps growing. Let me show you specific numbers for a retiree. You're 65 years old. You have $500,000 to invest. You put $200,000 into VIG. The dividend yield is 1.8%. You receive $3,600 in the first year, $300 per month. Not enough to live on. But this is just one piece of your income portfolio. The dividends grow at 8% annually. Year 5, you're receiving about $5,300, $440 per month. Year 10, you're receiving about $7,800, $650 per month. Year 15, you're receiving about $11,500, almost $1,000 per month. Year 20, you're receiving about $17,000, $1,400 per month. And remember, you haven't sold a single share. Your original $200,000 investment is still there. In fact, it's probably grown to $300,000 or more because these high-quality dividend growth stocks tend to appreciate over time. So you're getting growing income plus capital appreciation. This is ideal for retirement. Now let me address concerns about VIG. Warren, what if there's a bear market? Won't VIG fall and force me to sell at a loss? Yes, VIG will fall during bear markets. In 2008, it fell about 30%. In 2020, during COVID, it fell about 25%. But here's the key. You're not selling VIG to fund living expenses in the first few years of retirement. You have other investments for near-term cash flow, which I'll explain when I reveal the other 2 income investments. VIG is your long-term income engine. It provides growing income over decades. You can hold through temporary price declines because you're not forced to sell. Warren, a 1.8% yield is too low. I need more income now. I understand the temptation to chase higher yields, but high yields are usually a trap. They come from stocks or funds that have cut their dividends or are about to. The stock price falls, which mechanically increases the yield, but then the dividend gets cut and you lose on both the income and the capital. VIG's low current yield is actually a sign of quality. These companies don't need to pay high dividends to attract investors. They're growing businesses that reinvest profits intelligently and still have money left over to pay increasing dividends. That's sustainability. Warren, what about fees? The expense ratio on VIG is 0.06%, 0.06%. That's $6 per year for every $10,000 invested. Incredibly cheap. Over decades, this tiny fee saves you tens of thousands compared to actively managed dividend funds that charge 1% or more. VIG meets all my criteria. Reliable dividends from high-quality companies. Strong dividend growth that protects against inflation. reasonable safety of principal from blue chip stocks, tax-efficient qualified dividends, highly liquid, simple to own. This is the foundation of a retirement income portfolio. Now, let me talk about how much of your portfolio should be in VIG. If you're a younger retiree, 60 to 70 years old, with a long time horizon, you could put 40 to 50% of your portfolio in VIG. You have decades for the dividend growth to compound. You can afford to ride out market volatility. If you're an older retiree, 75 plus, you might reduce this to 20 to 30%.
You need more stable income from the other two investments I'm about to reveal. The key is balancing long-term dividend growth with near-term income stability. VIG provides the growth.
The next two investments provide the stability. The second income investment I would buy for retirement is a portfolio of individual investment-grade corporate bonds with staggered maturities. I call this a bond ladder. Let me explain exactly what this means and why it's superior to bond funds for retirement income. A bond ladder is when you buy individual bonds with different maturity dates. For example, you buy 10 bonds. One matures in 1 year, one in 2 years, one in 3 years, all the way out to 10 years. Each bond pays interest semi-annually. When a bond matures, you get the principal back and buy a new 10-year bond. This creates a perpetual ladder where you always have bonds maturing that you can reinvest or use for living expenses. Here's why this is perfect for retirement. Predictable income. Each bond pays a fixed interest rate semi-annually. You know exactly how much you'll receive and when. If you own 10 bonds, each with a $1,000 face value paying 5% interest, you receive $500 per year from each bond, total $5,000 annually. Paid like clockwork. No surprises, no cuts, safety of principal. If you hold a bond to maturity, you get your full principal back. The price might fluctuate during the life of the bond. But if you don't sell, those fluctuations don't matter. You get par value at maturity. This eliminates the interest rate risk that destroys bond fund values when rates rise. Flexibility. Every year a bond matures and you get the principal back. You can reinvest it in a new 10-year bond, or you can use the principal for living expenses if you need extra cash. This gives you options that bond funds don't provide. Now, let me walk you through how to build a bond ladder for retirement. Step 1, determine how much to allocate. For a balanced retirement portfolio, I'd put 30 to 40% in bonds. If you have $500,000, that's $150,000 to $200,000 in bonds. Step 2, decide on the ladder length. I recommend 10 years. This gives you good balance between yield and flexibility. Longer ladders lock you in too long. Shorter ladders force you to reinvest too frequently. Step 3, buy individual investment-grade corporate bonds, not junk bonds, not emerging market bonds. Investment-grade corporates rated BBB or higher from companies like Apple, Microsoft, Johnson & Johnson, Walmart, Berkshire Hathaway. These companies will pay you back. Use a brokerage that offers bond trading. Fidelity and Schwab have good bond platforms. You can search for bonds by maturity, credit rating, and yield. Buy bonds with staggered maturities. If you have $200,000 to invest and want a 10-year ladder, buy $20,000 worth of bonds maturing in 1 year, $20,000 maturing in 2 years, and so on up to 10 years. Step 4, hold the bonds to maturity. Don't trade them. Don't try to capture price gains. Just hold and collect interest. When each bond matures, reinvest the principal in a new 10-year bond. This keeps the ladder going indefinitely. Let me give you a specific example. You're 65 and you allocate $200,000 to a bond ladder. You build a 10-year ladder with $20,000 invested at each maturity. The bonds yield an average of 5%. You receive $10,000 per year in interest income, $833 per month. Every year, $20,000 of principal matures. You reinvest it in new 10-year bonds at prevailing rates. If rates have risen to 6%, your new bonds yield more and your income increases. If rates have fallen to 4%, your new bonds yield less, but your older bonds still yield 5%, so the decline is gradual. This ladder provides stable income that adjusts slowly to interest rate changes, unlike bond funds that can lose significant value when rates rise. and unlike individual long-term bonds that lock you into one rate for decades. Now, let me address some concerns about bond ladders. Warren, isn't this complicated? Don't I need to actively manage it? It's more work upfront than buying a bond fund. You have to research and purchase individual bonds, but once the ladder is built, it runs itself. Once a year, you reinvest the matured bonds, maybe an hour work annually. That's manageable. Warren, don't I need a lot of money to diversify across individual bonds? You need at least $100,000 to build a proper ladder. Less than that, and you can't achieve adequate diversification. If you have less, use short-term bond funds like VGSH that I discussed in my bond fund video. But if you have $100,000 or more allocated to bonds, individual ladders are better. Warren, what if a company defaults? This is why you stick to investment-grade bonds from large, stable companies. The default rate on investment-grade corporates is about 0.1% annually, very low. And with 10 different bonds from 10 different companies, a single default costs you 10% of your bond portfolio at most. Painful, but not catastrophic. And honestly, if you're buying bonds from Apple or Microsoft or Johnson & Johnson, default risk is essentially zero. These companies have fortress balance sheets. They're not defaulting. The bond ladder meets all my criteria. Highly reliable income from contractual interest payments, some growth potential as you reinvest matured bonds at higher rates if rates rise. Safety of principal as long as you hold to maturity. Tax efficiency because interest is taxed as ordinary income, but at least it's predictable. Good liquidity because you can sell bonds if needed, though you prefer to hold to maturity. Reasonable simplicity once built. This is the stability anchor of a retirement income portfolio. Now let me talk about the allocation. For younger retirees, 60 to 70, I'd allocate 30% to bond ladders. For older retirees, 75 plus, I'd allocate 40 to 50%. As you age, you shift from dividend growth stocks to bonds for more stable, predictable income. The third and final income investment I would buy for retirement is real estate investment trusts, specifically a diversified REIT index fund. The ticker I'd use is VNQ, the Vanguard Real Estate Index Fund ETF. Let me explain why REITs are excellent for retirement income. REITs are companies that own income-producing real estate. Apartment buildings, shopping centers, office buildings, warehouses, data centers, cell towers. They collect rent from tenants and distribute most of that income to shareholders as dividends. By law, REITs must distribute at least 90% of their taxable income as dividends. This creates high dividend yields. VNQ currently yields about 4%. That's more than double VIG's yield. On $100,000, you receive $4,000 annually. $333 per month. This higher current income is valuable for retirees who need cash flow now, not in 10 years. But REITs also provide some dividend growth. As rents increase over time, REIT dividends increase. The growth is slower than dividend appreciation stocks, maybe 3 to 5% annually instead of 8 to 10%, but it's still growth. Your 4% yield becomes 4.1%, then 4.3%, gradually increasing to protect against inflation. REITs also provide diversification. Real estate returns are not perfectly correlated with stocks or bonds. When stocks are falling, real estate might hold steady or even increase if it's a flight to safety. This reduces overall portfolio volatility. VNQ holds about 160 REITs across different property types. Residential REITs that own apartments, industrial REITs that own warehouses and distribution centers, retail REITs that own shopping centers, office REITs, data center REITs, cell tower REITs, specialized REITs that own things like storage facilities, healthcare properties, even billboards. This diversification means you're not dependent on any single property type doing well. Let me give you the numbers for a retiree. You allocate $100,000 to VNQ. The yield is 4%. You receive $4,000 in year one. The dividend grows at 4% annually. Year 5, you're receiving about $4,800. Year 10, about $5,900. Year 15, about $7,200. Year 20, about $8,700. This is solid income growth. Not as aggressive as VIG's 8 to 10% dividend growth, but more than enough to keep pace with inflation. And you're starting from a 4% yield instead of 1.8%, so your current income is much higher. Now let me address concerns about REITs. Warren, aren't REITs risky? Didn't they get crushed in 2008? Yes, REITs fell about 70% during the financial crisis. That was brutal, but that was a crisis centered on real estate. Mortgages were defaulting, property values were collapsing, REITs were at the epicenter. In a typical recession, REITs don't fall that much. In 2002, they actually held up well while stocks fell. In 2020, during COVID, REITs fell about 30% but recovered quickly. The key is that REITs own physical assets that generate income. As long as tenants pay rent, REITs can pay dividends. And most REIT properties have long-term leases with creditworthy tenants. The income is relatively stable. Warren, what about interest rates? Don't REITs get crushed when rates rise? REITs are sensitive to interest rates because they're valued based on the yield they provide. If a REIT yields 4% and Treasury bonds yield 2%, the REIT looks attractive. But if Treasury yields rise to 5%, the REIT's 4% yield looks less attractive. Investors sell REITs and buy Treasuries. REIT prices fall. This happened in 2022 when rates spiked. The NQ fell about 25%. But here's the key. REIT dividends didn't fall. The income kept coming. If you were living on that 4% yield, you still received your $4,000 per year on $100,000 invested. The price decline didn't matter if you weren't selling. And over time, as REIT dividends grow because rents increase, the yield becomes more attractive again. Prices recover. It's temporary volatility, not permanent impairment. Warren, aren't REIT dividends taxed as ordinary income? Isn't that tax inefficient? Partially true. REIT dividends are not qualified dividends. Most of the dividend is taxed as ordinary income. Some portion might be return of capital or capital gains, which are taxed more favorably. But yes, the tax treatment is worse than qualified dividends from stocks. This is why if you're holding REITs, you want to hold them in tax-advantaged accounts like IRAs or Roth IRAs where the tax treatment doesn't matter. If you must hold them in taxable accounts, understand you'll pay more in taxes. Despite these concerns, VNQ meets most of my criteria. Reliable income from rent collection, moderate dividend growth as rents increase, reasonable safety of principal from owning physical assets, though subject to real estate cycles. Liquidity is excellent. Tax efficiency is the weak point. Simplicity is excellent. Overall, it's a good income investment for the right portion of a retirement portfolio. Now, let me talk about allocation. I'd put 20 to 30% of a retirement portfolio in REITs. Not more because of the tax inefficiency and interest rate sensitivity, but enough to generate meaningful current income and provide real estate diversification. For younger retirees, 20%. For older retirees needing more current income, 30%. So let me bring all three investments together and show you a complete retirement income portfolio. You're 65 years old. You have $500,000. You need to generate income to supplement Social Security. Here's how I'd allocate it. 40% in VIG, the dividend appreciation ETF. That's $200,000. Current dividend yield is 1.8%. You receive $3,600 in year one, but this grows at 8% annually. By year 10, you're receiving about $7,800. By year 20, about $17,000. This is your inflation-fighting long-term income engine. 30% in a bond ladder, that's $150,000. You build a 10-year ladder with bonds yielding an average of 5%. You receive $7,500 annually, $625 per month. This is your stable, predictable income. 25% in VNQ, the REIT index fund. That's $125,000. Yield is 4%. You receive $5,000 in year one, growing at 4% annually. By year 10, about $7,400. This is your current income and real estate diversification. 5% in cash, that's $25,000. Emergency fund for unexpected expenses, held in a money market fund yielding about 5%, generates $1,250 annually. Total first year income from the portfolio, VIG 3,600 plus bond ladder 7,500 plus VNQ 5,000 plus cash 1,250 equals $17,350. That's about $1,445 per month, plus Social Security. Let's say you receive $2,000 per month from Social Security. Total monthly income is $3,445. That's $41,340 annually, enough for a comfortable retirement for most people. And here's the beautiful part. Your income grows over time. Year 5, your portfolio income has grown to about $22,000 annually. Year 10, about $29,000. Year 15, about $37,000. Year 20, about $48,000. This is just from the dividend and interest growth. Your Social Security also increases with cost of living adjustments. So your total income keeps pace with or exceeds inflation. You're not going backwards. You maintain your standard of living throughout retirement. Now let me talk about the withdrawal strategy because this is critical. In the early years of retirement, you live entirely on the income from dividends, interest, and Social Security. You don't sell any shares of VIG or VNQ. You don't break the bond ladder. You just collect the income. This allows your principal to stay intact and even grow. VIG and VNQ will appreciate over time. Your portfolio value might grow from $500,000 to $600,000 or $700,000 even as you're living on the income. In later years, if you need additional money for health care or other expenses, you can start selectively selling shares, or you can break part of the bond ladder and use principal, but this is a last resort. The goal is to live on income alone and preserve principal. If you do this, you'll never run out of money. Your portfolio will last your entire lifetime and you'll have assets to pass to your heirs. Now let me address the biggest mistake retirees make with income investing: chasing yield. They see a stock or fund yielding 8 or 10% and think they found a gold mine. They invest heavily and then the dividend gets cut or the investment collapses and they lose most of their capital. High yields are almost always a red flag. They indicate either excessive risk or an unsustainable dividend. The market is telling you something is wrong. Maybe the company is over-leveraged. Maybe their business is declining. Maybe the dividend will be cut soon. When I see a yield that's dramatically higher than similar investments, I assume there's a problem. I stay away. The 3 investments I've recommended have modest yields by high yield standards. VIG at 1.8%, VNQ at 4%, bonds at 5%. Blended, the portfolio yields about 3.5%. That's not going to wow anyone, but it's sustainable, it's reliable, and it grows. That's worth far more than a 10% yield that disappears in 2 years. Another mistake is putting everything in bonds for safety. Retirees think bonds are safe and stocks are risky, so they go 100% bonds. This is a disaster for 2 reasons. 1, bonds don't grow. Your income stays flat while inflation erodes purchasing power. Over a 30-year retirement, you go from comfortable to poverty. 2, bonds are not actually safe in all environments. When inflation spikes and interest rates rise, bonds lose significant value. 2022 proved this. Bonds had their worst year in history. The investors who thought they were playing it safe got crushed. You need balance. Stocks for growth, bonds for stability, REITs for income and diversification. A third mistake is not accounting for taxes. Retirees often hold income investments in taxable accounts without thinking about the tax consequences. They generate $50,000 in income. They pay $15,000 in taxes. Suddenly their $50,000 is only $35,000. They can't cover their expenses. Plan for taxes. Use tax-advantaged accounts for tax-inefficient investments like REITs and bonds. Hold tax-efficient investments like dividend stocks in taxable accounts. Structure withdrawals to minimize taxes. This can save you tens of thousands of dollars annually. A fourth mistake is not planning for required minimum distributions from retirement accounts. Once you turn 73, you must withdraw a certain percentage from traditional IRAs and 401k plans. These withdrawals are taxed as ordinary income. Many retirees don't plan for this. They're forced to take large withdrawals they don't need and pay huge taxes. The solution is to do Roth conversions before required minimum distributions start. Convert traditional IRA money to Roth IRA in your 60s when you're in a lower tax bracket. Pay taxes on the conversions, but then the money grows tax-free and you don't have RMDs. This takes planning, but it can save enormous amounts in taxes over retirement. Now, let me talk about adjusting the portfolio as you age. The allocation I described, 40% VIG, 30% bonds, 25% REITs, 5% cash, works well for someone 65 to 75. But as you get older, you should shift toward more stable income and less growth. At 75, you might shift to 30% VIG, 40% bonds, 25% REITs, 5% cash. At 85, maybe 20% VIG, 50% bonds, 25% REITs, 5% cash. The idea is to gradually increase the portion that provides stable, predictable income and decrease the portion that requires longer time horizons to realize growth. But don't eliminate stocks entirely, even at 90. You need some growth to combat inflation. And if you're married, there's a good chance one spouse lives into their 90s. That's a 30-year retirement. Inflation will destroy you without any stock exposure. Now, let me address what happens if there's a major market crash in the first few years of retirement. This is the nightmare scenario. Sequence of returns risk. You retire at 65, you have $500,000. The market crashes 50% in year 2. Your VIG and VNQ holdings are now worth only $162,500 instead of $325,000. Your total portfolio is down to $337,500, and you're withdrawing money for living expenses. The combination of market losses and withdrawals devastates the portfolio. It never recovers. This is a real risk, and it's why you have bonds and cash. When the market crashes, you stop withdrawing from VIG and VNQ entirely. You live on the bond ladder, interest and bond principal. You might break the ladder and use some of the principal from maturing bonds. You also use the cash emergency fund. This allows VIG and VNQ to sit there down 50% without you having to sell. You don't lock in the losses. The stocks just sit and wait. Eventually, the market recovers. VIG and VNQ come back. By the time you've exhausted the bond principal and cash reserves, the stock portion has recovered. You've avoided the sequence risk disaster. This is why the allocation across stocks, bonds, and cash is so important. The bonds and cash are insurance against being forced to sell stocks at terrible prices. Let me give you a specific scenario. Year 1 of retirement, portfolio is $500,000. Year 2, market crashes 50%. VIG and VNQ down from $325,000 to $162,500. Bonds and cash stable at $175,000. Total portfolio $337,500. You need $35,000 for living expenses beyond Social Security. You take $7,500 from bond ladder interest. You take $5,000 from REIT dividends. You take $3,600 from VIG dividends. Even though VIG is down 50% in price, the dividends are still being paid. You take the remaining $18,900 from maturing bonds in the ladder and from cash. You don't sell any shares of VIG or VNQ. You repeat this for several years while the market recovers. By year 5, the market has recovered. VIG and VNQ are back to their original values and higher. Your bond ladder and cash are depleted, but you've survived the worst-case scenario without locking in losses. This is the power of proper asset allocation and withdrawal sequencing. Now, let me talk about healthcare costs, because this is the biggest wild card in retirement. The average couple retiring at 65 will spend about $300,000 on healthcare over the rest of their lives. That's not including long-term care. Just Medicare premiums, supplemental insurance, out-of-pocket costs, prescriptions, if you need assisted living or nursing home care, add another $100,000 to $300,000 or more. These costs will consume a huge portion of your retirement income. You need to plan for them. One option is to self-insure. Keep extra money in your portfolio to cover health care. This means you need a larger portfolio, maybe $600,000 instead of $500,000. The extra $100,000 is your healthcare buffer. Another option is long-term care insurance. You pay premiums during your 60s and 70s. If you need care in your 80s or 90s, the insurance pays for it. This protects your portfolio from catastrophic long-term care costs. The premiums are expensive, maybe $5,000 to $10,000 per year, but it might be worth it for peace of mind. I tend to prefer self-insuring if you have enough assets. Long-term care insurance is expensive and the policies are complex, but everyone's situation is different. Run the numbers for your specific circumstances. Now let me close with the most important lesson about retirement income investing. It's not about maximizing returns. It's about maximizing the probability that you never run out of money. When you're accumulating wealth, you can take risks. You can chase high returns. If things go wrong, you have time to recover. You keep working. You keep adding money. But in retirement, you can't afford to lose. A major portfolio loss could ruin your entire retirement. You'd have to slash your standard of living, depend on family, go back to work if you even can. The downside of failure is catastrophic. So you optimize for safety and sustainability, not for maximum returns. The three investments I've recommended, VIG, bond ladders, and VNQ, are boring. They won't make you rich, but they'll provide reliable, growing income for as long as you live. They'll let you sleep at night. They'll give you the freedom to enjoy retirement without constantly worrying about money. That's worth far more than chasing an extra percentage point of return on some risky investment. I've seen too many people destroy their retirements by making one bad decision. They buy an annuity with terrible fees. They invest in a high-yield bond fund that collapses. They get talked into a complicated, structured product they don't understand. One mistake, that's all it takes. By sticking to simple, high-quality, transparent investments like the three I've described, you avoid these mistakes. You give yourself the best chance of a comfortable, financially secure retirement. So here's my recommendation for retirement income in 2026. Build a portfolio with 40% in VIG for dividend growth, 30% in a bond ladder for stable income, 25% in VNQ for current yield and diversification, and 5% in cash for emergencies. Live on the income from dividends and interest. Don't sell shares unless absolutely necessary. Let the dividend growth protect you from inflation. Rebalance annually to maintain your target allocation. Gradually shift toward more bonds and less stocks as you age. Plan for healthcare costs. Minimize taxes through smart account placement and withdrawal sequencing. And most importantly, resist the temptation to chase higher yields or try to outsmart the market. Boring and reliable beats exciting and risky every time in retirement. Follow this strategy and you'll have income for life. Income that grows, income that sustains your standard of living, income that allows you to enjoy your retirement years without financial stress. That's what retirement income investing should deliver. And that's exactly what these three investments will provide. Let me go much deeper into the practical implementation of this retirement income strategy because the details matter enormously. The difference between a successful retirement and running out of money often comes down to execution, not just strategy. Starting with VIG, the Vanguard Dividend Appreciation ETF, I want to show you exactly how to use this in retirement. Most people think dividend stocks are simple. You buy them and collect the dividends, but there's much more to it. First, understand what you're actually buying. VIG holds about 300 stocks, but they're not equally weighted. The largest holdings represent a bigger portion of the fund. As of the most recent data, the top 10 holdings represent about 30% of the fund. These include Microsoft, Apple, United Health, JP Morgan Chase, Visa, Procter & Gamble, Home Depot, Broadcom, MasterCard, and Costco. Notice these are all high-quality, dominant businesses. They're not speculative companies. They're not turnaround stories. They're proven winners that have increased dividends for decades. This composition changes gradually over time as companies are added or removed based on their dividend track records. The fund has strict criteria. A company must have increased its dividend for at least 10 consecutive years to be included. If a company freezes or cuts its dividend, it's removed. This automatic filtering keeps the fund focused on quality. The methodology is crucial because it creates a self-cleansing portfolio. Bad companies get removed automatically. You don't have to watch the fund closely or worry about management making poor decisions. The rules-based approach handles everything. Now let me talk about the dividend payment schedule. VIG pays dividends quarterly, March, June, September, and December. The exact dates vary slightly each year, but it's consistent.
This quarterly payment schedule is important for budgeting. You know approximately when money will hit your account. You can plan your expenses around these payments.
The amount of each quarterly payment varies slightly because different companies in the fund pay dividends at different times. Some pay in the first month of the quarter, some in the second month, some in the third. VIG collects all these dividends and distributes them quarterly to shareholders. Let me give you a detailed example of how this works in practice. You own 1,000 shares of VIG at $100 per share. Your investment is $100,000. The current dividend yield is 1.8% annually. That's $1,800 per year. Divided by 4 quarters, you receive about $450 per quarter. But here's what happens over time. VIG's dividend grows at about 8% per year on average. Next year, your annual dividend is about $1,944, $486 per quarter. Year 5, about $2,645 annually, $661 per quarter. Year 10, about $3,888 annually, $972 per quarter. Notice that your quarterly payments have more than doubled in 10 years without you buying a single additional share. This is dividend growth compounding. Now let me address the reinvestment decision. Should you reinvest dividends automatically or take them as cash? The answer depends on your situation and the market environment. In early retirement, 60s to mid-70s, if you don't need all the dividend income for living expenses, reinvest it. This accelerates compounding. Each reinvested dividend buys more shares, which generate more dividends, which buy even more shares. The snowball effect is powerful. But there's a nuance here. Don't reinvest blindly. If VIG is dramatically overvalued, maybe don't reinvest. Take the cash and deploy it elsewhere or wait for better prices. How do you know if it's overvalued? Look at the price to earnings ratio. VIG typically trades at about 20 to 25 times earnings. If it's above 30, it's expensive. Consider holding cash instead of reinvesting. In late retirement, mid-70s and beyond, take the dividends as cash, use them for living expenses. This is what they're for. You've spent decades building this income stream. Now enjoy it. Don't keep reinvesting when you should be spending. One mistake I see constantly is retirees who keep reinvesting everything out of habit. They built wealth by reinvesting for 40 years. They can't break the habit, so they reinvest in retirement and don't use the money they've accumulated. Then they die with millions still invested. Their heirs are happy, but the retiree never enjoyed the wealth they built. Use the income. That's the point. Now let me talk about tax planning with VIG. The dividends are qualified dividends, which means they're taxed at favorable rates. For most retirees, the tax rate on qualified dividends is 0 or 15%. 0% if your taxable income is below about $90,000 for married couples filing jointly. 15% if your income is between $90,000 and $550,000. 20% above that. Most retirees fall into the 0 or 15% brackets. This means your dividend income is taxed much more favorably than ordinary income like interest from bonds. Here's a specific tax example. You receive $10,000 in qualified dividends from VIG. Your total taxable income, including Social Security and other sources, is $70,000. You're in the 0% bracket for qualified dividends. You pay 0 tax on the $10,000. You keep all of it. Compare that to $10,000 of bond interest taxed as ordinary income. At a 12% marginal tax rate, you'd pay $1,200 in federal taxes, plus state taxes if applicable. You'd keep only $8,800 or less. The tax difference compounds dramatically over decades. Over a 30-year retirement, the difference between 0% tax on dividends versus 12% on interest could be hundreds of thousands of dollars. This is why holding dividend stocks in taxable accounts and bonds in tax-deferred accounts makes sense. You optimize the tax treatment. Now, let me talk about bond ladders in much greater detail because this is where most people struggle. Building a bond ladder sounds complicated. It's not, but you need to understand the mechanics. Step 1 is determining your allocation. Let's say you have $500,000 total and you want 30% in bonds. That's $150,000. Step 2 is deciding the ladder length. I recommend 10 years for most retirees. This means you'll have bonds maturing every year for the next 10 years. Step 3 is determining how much to invest at each rung. With a $150,000 ladder over 10 years, you invest $15,000 at each maturity, one bond maturing in 1 year, one in 2 years, one in 3 years, up to 10 years. But here's where it gets practical. You can't buy exactly $15,000 of a single bond. Bonds are sold in $1,000 increments usually. So you'd buy 15 bonds of $1,000 each at each maturity. Or you might buy 3 bonds of $5,000 each. The denominations vary by bond. Step 4 is finding the right bonds. Use a bond screener at Fidelity, Schwab, or another broker. Filter for investment-grade corporate bonds, which means rated BBB or higher. Filter for the maturity you want. If you're building the 1-year rung of the ladder, filter for bonds maturing in about 12 months. Look at the yield to maturity. This tells you what you'll earn annually if you hold the bond to maturity. Current yields on investment-grade corporates are about 5 to 6% depending on maturity and credit quality. Choose bonds from companies you recognize and trust: Apple, Microsoft, Johnson & Johnson, Walmart, Coca-Cola, JP Morgan Chase. These are not going to default. Don't reach for yield by buying bonds from companies you've never heard of. You're not trying to maximize return. You're trying to ensure you get paid back. Step 5 is purchasing the bonds. Place orders through your brokerage account. Buy the bonds at the ask price. You'll pay a small markup, maybe $10 to $30 per bond. This is normal. It's how bond dealers make money. Hold the bonds in your account. You'll receive interest payments semi-annually. The broker deposits the interest directly into your cash account. When the bond matures, the principal is returned to your cash account automatically. You then use that cash to buy a new 10-year bond, creating the perpetual ladder. Let me give you a very specific example with actual numbers. You're building the 1-year rung of your ladder. You need to invest $15,000. You search for bonds maturing in 12 months. You find an Apple corporate bond maturing in November 2026 with a 5% coupon. The bond is priced at par, meaning $1,000 per bond. You buy 15 bonds for $15,000 total. Every 6 months, you receive $37.50 per bond in interest. That's 2.5% of $1,000 per half year, total 5% annually. With 15 bonds, you receive $562.50 every 6 months, $1,125 annually. In November 2026, the bonds mature. You receive your $15,000 principal back. You take that $15,000 and buy new 10-year bonds. Maybe you find a Microsoft bond maturing in November 2036, yielding 5.5%. You buy 15 bonds. Now you're earning $825 annually from this rung of the ladder instead of $1,125, because the new bonds yield 5.5% on 15,000 instead of 5%. Wait, that's wrong. 5.5% of 15,000 is $825, but I said the new bonds yield more. Let me recalculate. If the new bonds yield 5.5%, you earn 5.5% of 15,000, which is $825. That's less than the 5%, which was $750. No, wait, 5% of 15,750, 5.5% is 825. So the income went up from 750 to 825. That's correct. The point is that as bonds mature and you reinvest at prevailing rates, your income adjusts. If rates have risen, you earn more. If rates have fallen, you earn less. The ladder smooths this out because you're only reinvesting 1/10 of your bond portfolio each year. You're not subject to dramatic swings. Now let me address some common bond ladder questions. What if I can't find good bonds at every maturity? This happens sometimes. Maybe there aren't many high-quality bonds maturing in exactly 3 years. You can buy bonds maturing in 2.7 years or 3.2 years. Close enough. The ladder doesn't have to be perfect. The goal is to have bonds maturing at roughly regular intervals. What if interest rates rise right after I build my ladder? Won't I be stuck with low-yielding bonds? Partially. The bonds you already bought are locked in at their original yields. But every year, 1/10 of your bonds mature and you can reinvest at higher rates. So your income gradually rises. If rates rise from 5% to 6%, It takes about 10 years for your entire ladder to be reinvested at the higher rate. During that time, your blended yield moves from 5% towards 6% gradually. This is actually a feature, not a bug. It prevents your income from swinging wildly. What if I need to sell a bond before maturity? You can sell, but you'll get the market price, which might be below what you paid. If interest rates have risen since you bought, the bond's price will have fallen. You'll take a loss. This is why you build the ladder with bonds you intend to hold to maturity. The ladder provides liquidity because you have bonds maturing every year. You shouldn't need to sell before maturity. Can I build a ladder with municipal bonds instead of corporate bonds? Yes. If you're in a high tax bracket, municipal bonds pay interest exempt from federal taxes and sometimes state taxes. But the yields are lower to compensate for the tax advantage. Do the math to see if munis make sense for your situation. For most retirees in moderate tax brackets, taxable corporate bonds and tax-deferred accounts are better. Now let me talk about VNQ, the Vanguard Real Estate Index Fund, in greater detail. REITs are misunderstood by most investors, so I want to clarify exactly what you're buying and how to use it. VNQ holds about 160 different REITs spanning multiple property types. The largest categories are residential, about 15%, industrial and office, about 13% each, retail, about 8%, and specialized REITs, about 50%. Specialized REITs include cell towers, data centers, self-storage, healthcare facilities, and other niche property types. The diversification is important because different property types perform differently in different economic environments. Residential REITs, which own apartment buildings, tend to be stable. People always need housing. Rents might fluctuate, but demand is persistent. Industrial REITs, which own warehouses and distribution centers, have been strong performers because of e-commerce growth. Every Amazon package ships from a warehouse somewhere. Data center REITs have boomed because of cloud computing and AI. Every Google search and Netflix stream requires data center space. Cell tower REITs benefit from wireless data growth. Every smartphone needs cell towers to connect. Retail REITs, which own shopping malls and strip centers, have struggled because of e-commerce competition. But the best retail REITs own grocery-anchored centers and necessity-based retail that can't be easily replaced by online shopping. Office REITs have been challenged by work-from-home trends. But the highest quality office REITs own prime properties in gateway cities that still command strong rents. By owning VNQ, you get exposure to all these property types without having to pick winners and losers. The diversification protects you. Now let me talk about REIT dividend mechanics because they're different from regular stock dividends. REITs are required by law to distribute at least 90% of taxable income to shareholders. This means they pay out almost all of their profits. They can't retain earnings to reinvest in growth. If they want to buy new properties, they have to raise capital by issuing new shares or taking on debt. This structure creates high dividend yields but limits growth. The dividends from REITs are classified differently for tax purposes. A portion is ordinary income, taxed at your marginal rate. A portion might be return of capital, which isn't taxed currently but reduces your cost basis. A portion might be capital gains from property sales, taxed at capital gains rates. The exact breakdown varies by REIT and by year. The broker sends you a 1099 DIV form that details the classification. For simplicity, assume most REIT dividends are taxed as ordinary income. This is why REITs belong in tax-deferred accounts like IRAs if possible. In a traditional IRA, the dividend income isn't taxed until you withdraw. In a Roth IRA, it's never taxed. This saves you significant taxes over decades. Let me give you numbers for VNQ in retirement. You invest $100,000 at age 65. VNQ yields 4%. You receive $4,000 in year one. The dividend grows at 4% annually. Year 5, you're receiving about $4,866. Year 10, about $5,920. Year 15, about $7,206. Year 20, about $8,765. This income growth keeps pace with inflation, protecting your purchasing power. But VNQ is also volatile. The price will fluctuate significantly. In good years, VNQ might appreciate 15%. In bad years, it might fall 25%. This volatility is higher than bonds but lower than stocks. The key is focusing on the dividend income, not the price. As long as the dividends keep coming and growing, temporary price declines don't matter. You're not selling, you're collecting income. Now let me bring all three investments together in a comprehensive portfolio example with actual numbers and scenarios. You're 65, you have 500,000, you allocate 200,000 to VIG, 150,000 to a bond ladder, 125,000 to VNQ, and 25,000 to cash. Year one income, VIG pays 1.8% on 200,000 equals $3,600. Bond ladder pays 5% on 150,000 equals $7,500. VNQ pays 4% on 125,000 equals $5,000. Cash pays 5% on 25,000 equals $1,250. Total income, $17,350. That's $1,445 per month. You also receive Social Security, let's say $2,500 per month. Total monthly income, $3,945. Annual income, $47,340. Your expenses are $40,000 per year. You're spending less than you earn. The surplus, $7,340, gets reinvested or saved. You're in great shape. Year 5, VIG dividend has grown to about $4,938 at 8% annual growth. Bond ladder still paying $7,500. Assuming you reinvested matured bonds at similar rates, VNQ dividend has grown to about $6,083 at 4% annual growth. Cash at $1,250. Total income $19,771. Social Security has increased to about $2,800 per month with COLAs. Total income $53,371. Expenses have increased to about $44,000 due to inflation, still spending less than earning. Surplus $9,371. Year 10 VIG dividend, now about $7,773. Bond ladder $7,500. VNQ dividend about $7,401. Cash $1,250. Total income $23,924. Social Security about $3,150 per month. Total income $61,724. Expenses increased to about $48,000. Surplus $13,724. Year 15 VIG dividend about $12,248. Bond ladder $7,500. VNQ dividend about $9,014. Cash $1,250. Total income $30,012. Social Security about $3,550 per month. Total income $72,612. Expenses about $53,000. Surplus $19,612. Year 20 VIG dividend about $19,293. Bond ladder $7,500. VNQ dividend about $10,975. Cash $1,250. Total income $39,018. Social Security about $4,000 per month. Total income $87,018. Expenses about $58,000. Surplus $29,018. Notice what happened. Your income from the portfolio alone grew from $17,350 to $39,018 over 20 years, more than doubled. This kept pace with inflation and then some. Your total income, including Social Security, grew from $47,000 to $87,000. You maintained purchasing power and actually increased your real income. Your expenses grew from $40,000 to $58,000, about 45% increase over 20 years. That's about 2% annual inflation. Manageable, and you never ran out of money. In fact, you had surpluses every year that could be reinvested or used for healthcare costs or passed to heirs. Now let me show you the disaster scenario so you understand what to avoid. Same starting point, $500,000, same allocation, but you made different decisions. Instead of VIG, you bought high-yield stocks yielding 8%. These stocks don't grow dividends. They actually cut dividends in year 3 during a recession. Your income from stocks drops from $16,000 to $8,000. Catastrophic. Instead of a bond ladder, you bought a long-term bond fund yielding 6%. Interest rates rise in year 2. The bond fund loses 25% of its value. Your $150,000 is now $112,500. Income dropped from $9,000 to about $6,750 because some bonds matured and were replaced with lower yielding bonds as rates fell later. Instead of VNQ, you bought a high-yield mortgage REIT yielding 10%. This REIT uses leverage to amplify returns. In year 4, there's a financial crisis. The REIT cuts its dividend by 60%. Your income drops from $12,500 to $5,000. Your total portfolio income in year 5 is $8,000 from stocks plus $6,750 from bonds plus $5,000 from the mortgage. REIT equals $19,750. This is higher than the safe portfolio's year 5 income of $19,771. But wait, the high-yield portfolio also suffered capital losses. The stocks that cut dividends fell 50%. Your $200,000 is now $100,000. The bond fund lost 25%. Your $150,000 is $112,500. The mortgage REIT fell 70%. Your $125,000 is $37,500. Your total portfolio value is now $275,000 instead of the original $500,000. You lost 45% of your capital, and your income dropped from $41,000 in year 1 to $19,750 in year 5. You can't cover expenses. You're forced to sell assets at depressed prices. This accelerates the decline. By year 10, you're out of money. This is the nightmare. This is what happens when you chase yield without considering sustainability and risk. The safe portfolio with VIG, bonds, and VNQ might have had lower starting income, but it grew reliably and preserved capital. 30 years later, you still have money. The high-yield portfolio had higher starting income, but it collapsed under stress. 10 years later, you're broke. This is why I'm so adamant about focusing on quality and sustainability over yield. The extra few percentage points of income aren't worth the risk of total failure. Now, let me talk about specific adjustments you should make based on your personal situation. If you have a pension that covers most of your basic expenses, you can be more aggressive with your portfolio. Maybe 60% in VIG, 20% in bonds, 20% in VNQ. The pension provides the stable income. The portfolio can focus more on growth. If you have no pension and Social Security is low, you need more stable income now. Maybe 30% VIG, 40% bonds, 30% VNQ. This gives you higher current income to supplement the meager Social Security. If you're married and both spouses have long life expectancies, plan for a 40-year retirement. Keep more in VIG for long-term dividend growth. You'll need the inflation protection. If you're single or have health issues suggesting a shorter retirement, you can focus more on current income, bonds and REITs, less need for long-term growth. If you have significant health care costs or long-term care needs anticipated, keep more in cash and bonds. You need liquidity and stability. Can't afford volatility in the stock portion. If you're leaving a large inheritance to children or charity, keep more in growth assets like VIG. The capital appreciation benefits your heirs. The point is the framework is flexible. The 40, 30, 25, 5 allocation is a starting point. Adjust based on your specific needs and circumstances. Now, let me address one final critical topic. What to do when things go wrong. Despite your best planning, unexpected events happen. Market crashes, health crises, family emergencies, inflation spikes. How do you adjust the portfolio to handle these shocks? Scenario 1, major market crash in early retirement. You're 67. The market crashes 40%. Your VIG and VNQ holdings are devastated. Stop taking any withdrawals from VIG and VNQ. Live entirely on bond ladder income and interest. If necessary, start breaking the bond ladder and using principal from matured bonds. Reduce expenses if possible. Wait for markets to recover before resuming withdrawals from stocks. This is exactly what the bonds are for. They're your lifeboat during storms. Scenario 2, unexpected major medical expense. You need $50,000 for surgery not covered by insurance. Response: take withdrawals in this order. First, use the cash emergency fund. Second, break part of the bond ladder and use maturing principal. Third, if necessary, sell VNQ shares. Fourth, as a last resort, sell VIG shares. The hierarchy protects your long-term income sources. Cash and bonds are for emergencies. Stocks are for long-term income and should be preserved if at all possible. Scenario 3. Inflation spikes to 6% and stays there. Your expenses are rising faster than your income. Response: tighten expenses if possible. Delay taking Social Security if you haven't started yet to get a higher benefit later. If you must, start taking small withdrawals from VIG principal to supplement income. The dividend growth from VIG will eventually catch up to inflation, but there might be a painful transition period. This is also when you consider part-time work or monetizing hobbies if you're able. Scenario 4, interest rates fall to 0 again. Your bond ladder yields drop from 5% to 2% as bonds mature and you reinvest. Response: shift allocation gradually from bonds to dividend stocks. If bonds aren't yielding enough, you need more exposure to dividend growth. Maybe move to 50% VIG, 20% bonds, 30% VNQ. The stocks have to carry more weight. The key in all scenarios is staying calm and making rational adjustments. Don't panic sell, don't make dramatic changes, just adjust gradually based on the situation. Now let me close with a story that illustrates the power of this approach. I knew a couple who retired in 2000 with about $600,000. They built a portfolio similar to what I've described. Dividend growth stocks, a bond ladder, and some REITs. They lived on the income. They didn't panic during the 2000 to 2002 crash or the 2008 financial crisis. They just kept collecting their dividends and interest. 25 years later, in 2025, they're now 90 years old. Their portfolio has grown to $1.4 million despite them living off it for 25 years. The dividend income alone is now $70,000 per year. They're living better in retirement than they did while working. This is the power of quality income investments, dividend growth, and patient discipline. They didn't try to get rich. They didn't chase yields. They just bought quality, held forever, and lived on the income. It worked. That's what I want for you. A retirement where money isn't a constant source of stress, where you can enjoy your years without worrying about running out, where you can help your grandchildren take trips and live with dignity. These 3 income investments, VIG for dividend growth, bond ladders for stability, and VNQ for current income, will get you there if you implement them correctly and stick with a plan through thick and thin. So here's my final recommendation for retirement income in 2026. Start with the allocation I described. Adjust it to fit your specific situation. Build the portfolio carefully using quality investments. Live on the income, not the principal. Let dividend growth protect you from inflation. Rebalance once a year. Make gradual adjustments as you age. And above all, stay disciplined. Don't chase yields. Don't panic during crashes.
Don't try to outsmart the markets. Just own quality income investments and let time work for you. Do this and you'll have more than enough income for a comfortable retirement that lasts as long as you do.